Good afternoon. Yesterday, the market got the inflation number it had been dreading for a month, and it was good. Prices rose 3.5%, well below what anyone expected. Stocks ticked up. Yields eased. The odds of another rate hike got cut roughly in half. But here is what almost nobody said out loud. Gasoline fell 9.7% in a single month. That is where the good news came from, not from the economy cooling, from cheap fuel. And fuel was cheap in June because there was a ceasefire with Iran. That ceasefire collapsed on July 8th, 6 days before this report was even published. So yesterday, the market celebrated a photograph of a world that no longer exists. Let's get into it. Here's the board. Stocks rose modestly on the inflation print. The S&P closed up about 0.4% near 7,543. The Nasdaq gained 0.9 as chip stocks were bought back, and the Dow was essentially flat. Gold sits near $4,038 an ounce, easing slightly. Bitcoin is near 64,600, up over 3% in a day. And Brent crude settled at 84.73, a one-month high, up about 12% since Friday. Now, two honest notes on this board, because they matter more than the levels. First, Bitcoin's bounce is a bounce inside a bear market. A year ago today, Bitcoin traded near $117,800. It is $64,000 now. It has reclaimed its 200-week moving average, which is genuinely constructive, but a green day off cycle bottom support is not strength, and we are not going to dress it up as one. Second, on market concentration. This market is historically top-heavy. That is not in dispute, but every specific number we could find today came from either an unattributed blog, an undated banknote, or a May publication that fails our freshness bar. 4 sources, 4 different numbers. So we are telling you it is top-heavy, and we are not inventing a decimal point. If we cannot source it, you do not get a number. Now the signature segment, consensus versus the read. First, and this is today's deep dive. Everyone woke up yesterday and read 3.5% as the all-clear. Inflation is beaten, the Federal Reserve is done, risk on, but strip out energy and the story dissolves in your hands. Gasoline fell 9.7% for the month. Energy overall fell 5.7%. And core inflation, month over month, was flat. 0. That is not an economy cooling. That is a fuel bill falling. The fuel bill fell because of the June 17th ceasefire, and that ceasefire died on July 8th. Brent is back near $85 and up 12% since Friday, and the market's response to all of this was to price fewer rate hikes, not more. September hike odds fell from around 70% to roughly half, so the market got more dovish on the strength of an input that has already reversed. High conviction. Second read, you have probably seen the panic that the Strait of Hormuz is closed and that $200 oil is coming. It is not closed, and $200 is a ghost. Iran's Revolutionary Guard declared the strait closed on July 11th. Meanwhile, roughly 8.5 million barrels a day still moved through it on July 13th under United States naval escort. That is genuinely degraded against a normal of about 20 million, with transits down more than half. But degraded is not closed, and the $200 oil line going around right now is recycled rhetoric from February through May that simply never happened. Peak Brent in this entire conflict was $126. Analyst consensus this month is near 90. Here is the part that should settle it. Analysts price a genuine closure at $130 to $140 a barrel. Brent is at 85. The market is pricing contested but flowing, which is exactly what it is. The tape agrees with us, not with the panic. High conviction. Third read, there's a take going around that crypto is finally outperforming semiconductors. It is true on a 2-week window and false on every longer one. In the first half of this year, the semiconductor index rose 102%. It was the best performing major asset on the planet. Bitcoin fell 33% over the same stretch. Over 12 months, semiconductors are up 175%. Now, the rotation may genuinely be starting. Memory names have rolled over hard from their June peak, while Bitcoin bounced off 58,000, and that is worth watching closely. But crypto beats semiconductors, stated flatly, is a claim about which 2 weeks you chose to draw. Whenever someone shows you a relative performance chart, the first question is always, why does it start there? Medium conviction, and only on the rotation, not the claim. Follow the money. The regime question this week is not, is inflation beaten? It is, was the thing that beat it durable? And the answer is visibly no. Start with the print. Headline inflation fell to 3.5% from 4.2%. Core came down to 2.6 from 2.9. Month-over-month, headline fell 0.4%, the largest single-month drop since April of 2020. That is genuinely good news. And we are not going to pretend otherwise. But the composition is the entire story. Energy fell 5.7% for the month. Gasoline fell 9.7%, and core month-over-month was 0. The economy did not cool, oil did. Now the Federal Reserve is the one institution behaving like it noticed. The funds rate is 3.5 to 3.75%. And Chair Kevin Warsh, in his first congressional testimony as chair, on the very morning of the print, declined the victory lap about as pointedly as a central banker can. His words: "There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view." He added, "We have no tolerance for persistently elevated inflation. The market heard that and cut September hike odds anyway." July hike odds collapsed from about 42% to 16%. A hold on July 28th and 29th is now the overwhelming base case, and the live debate is hike versus hold, not cut. And one correction, because a widely shared claim got this wrong this week. There is no July 17th Federal Reserve meeting. The Fed's own calendar says July 28th and 29th. We checked. Now the oil side, and a sideshow that tells you how unserious the pricing is. This war began on February 28th. A memorandum of understanding on June 17th paused it. It collapsed on July 8th after attacks on commercial vessels, followed by American strikes and a reinstated naval blockade. Brent settled at $84.73, a one-month high, about 19% above pre-conflict levels. The June inflation report was measuring the quiet in between. Then this happened. On Monday, the administration announced a 20% reimbursement fee on all cargo transiting the Strait of Hormuz, a 20% toll on roughly a fifth of the world's seaborne oil. The International Maritime Organization objected that there is no legal basis for it. By Tuesday, it was gone, replaced with unspecified Gulf investment pledges. No dollar figure was ever attached to those pledges, so we are not attaching one either. Sit with that. A 20% tax on the most important choke point on Earth appeared and vanished inside 24 hours, and oil moved about 1.5%. Meanwhile, the real constraint is quiet and structural. The Strategic Petroleum Reserve sits at 319.5 million barrels. That is the lowest since April of 1983. 45% of capacity after nearly 90 million barrels of releases since March. The shock absorber this country used to lean on is the thinnest it has been in 43 years, at exactly the moment the shock came back. A word on sentiment and positioning, because it is the mirror image of the data. Our market and social sentiment monitoring shows the commentary is overwhelmingly reading this print as the end of the hiking cycle. The most shared market posts of the day were the headline number itself, celebrated at face value. Almost none of the amplification mentioned that energy did the work, and almost none of it mentioned that the ceasefire behind cheap energy was already 6 days dead when the number printed. That is the split worth noticing. The crowd is positioned for a Federal Reserve that is finished. The Federal Reserve chairman is on camera saying, "That is not my view." And the commodity that produced the good number is up 12% since Friday. When positioning, the data, and the policymaker all point in different directions. The crowd is usually the one that has to move. Here's the tell, the single most revealing data point of the day. $2.1 billion. That's the whole thing. The banking industry's case against yield-bearing stablecoins is existential in tone. Jamie Dimon says the banks will not accept it and that the system will blow up. Bank of America's chief executive has floated that 30 to 35% of all United States commercial bank deposits, trillions of dollars, could migrate to yield-bearing tokens. So the White House Council of Economic Advisors actually ran the numbers. Their finding, banning stablecoin yield would increase bank lending by $2.1 billion. That is 0.02% of the loan market. And it would impose roughly $800 million in net welfare cost. A cost-benefit ratio of 6.6 against the ban. The mechanism is unglamorous and decisive. 88% of stablecoin reserves already sit in treasuries and repo, so the dollars recirculate into the system rather than leaving it. That is the tell. When the defense of a rule delivers 0.02% of the benefit its champions imply, The fight was never about systemic risk. It is about who collects the spread. JP Morgan already runs its own deposit token on Coinbase's Base network and has since November of 2025. The objection is not to the technology. It is to paying you for the float. Sectors in play, 3 of them. Energy and shipping is the rearming risk. Hormuz transits are down more than half, roughly 6,000 seafarers are stranded, and vessels are switching off their tracking transponders, which means true flows may actually be higher than what we can measure. The read. The asymmetry is in the tails. Contested but flowing is priced. Actual closure is not, and neither is a durable piece. Second, memory and semiconductors, which are cheaper than the story admits. Micron trades near 6.9 times forward earnings, SK Hynix around 6 to 8, while sitting on roughly $100 billion of binding multi-year artificial intelligence memory contracts. Agreements that now run 5 years versus 1 year historically, with take-or-pay near 40% of revenue. The read. The market is pricing a classic cyclical top into a book that has been structurally decyclicalized. That is the interesting disagreement. And a correction while we are here. The widely repeated 8 times figure actually understates how cheap this is, and the analyst behind that call, Gil Luria, is at D.A. Davidson, not Bloomberg, as the viral version has it. Third, banks versus crypto rails, where the turf war just went live. On the radar, 6 things worth your attention. Today, the weekly petroleum status report and the next reading on that Strategic Petroleum Reserve. Last print, 319.5 million barrels, the lowest since 1983. The buffer is the story. Ongoing Hormuz transit volumes. 8.5 million barrels a day is the number to watch. Below about 6 million would break the contested but flowing pricing entirely. Around August 12th. July's inflation report, and this is the falsification test for everything we just told you. Energy should swing from minus 5.7% to positive. July 28th and 29th, the Federal Reserve decision. Hold is the base case, no new projections, and Warsh's tone is the signal, not the dots. By August 7th, a possible floor vote on the Clarity Act. It needs 60 votes, which means 7 Democrats. And the yield provision is the entire fight. An ongoing memory contract pricing. SK Hynix removed its price cap on long-term agreements. Micron did not. Watch that divergence. The scorecard, where we grade the dated calls, including the ones that go against us. And today, one did. On July 9th, we called that Grok 4.5's number 1 benchmark claim would fail independent scoring within 30 days. It did not. The Long Horizon Terminal Bench leaderboard independently confirms Grok 4.5 at rank number 1, with a mean reward of 0.505, solving 13 of 46 tasks. That call is falsified, and we are saying so plainly rather than quietly retiring it. The surviving nuance, which is not the same thing as being right, is that 29 of those 46 tasks remain unsolved by any model, so number 1 describes a frontier still scoring below half credit. Elsewhere, our call that cool inflation does not buy a July rate cut is tracking well. Hold is now consensus, though we will note the market's live debate turned out to be hike versus hold, meaning the risk sat on the opposite side from where we framed it. Our call that Brent does not sustainably hold above $80 absent an actual closure is under pressure at 85 and may well go red. 3 new calls go on the record today. 1. June's disinflation was rented, and it reverses. July's inflation report shows energy swinging from minus 5.7% to positive, and headline does not print below 3.5%. 2. The Strait stays contested but flowing through August. Transits hold above 6 million barrels a day, and Brent does not settle above $110. 3. The stablecoin fight is margin defense, not prudential risk. If a yield ban passes, deposits do not move anywhere near 35%. Observable shift stays under 2%. We date them, and we grade them. The close, the most expensive habit in markets is not being wrong. It is being right about a number that is no longer true. June's inflation report was accurate. The market's reaction to it was rational. And both of those things can be true while the conclusion is still wrong, because that report describes a June in which oil was cheap because nobody was shooting at tankers. On July 8th, they started again. And the one person in the building who said, "That is not my view," runs the Federal Reserve. So the question worth sitting with is not whether inflation is beaten. It is simpler and less comfortable. When the data you are trading arrives 5 weeks late, what exactly are you looking at? The the road, or the mirror, today's deep dive on this is on the channel now. The asymmetric signal, one contrarian read a day. Subscribe.